One second. YouTube is starting.
Hey,
One.
Christina, I'm just blurting in, but does this work for FBO account, or is this mainly just for business trust?
So this is for business owners, and then the FBO will file a 1041 if it was responsible. So you're going to be able to get information from this master class, okay? And then we're going to have a part two that's coming soon. So with that being said, hello, good evening, everyone. So welcome to the Wealthy Trustee Masterclass. We have a wonderful and phenomenal masterclass scheduled for you guys today. So welcome to all of my wealthy trustees. I'm super excited that you guys were able to fit in this masterclass because we have a wonderful class scheduled. Okay, so tonight we're going to be talking about tips on taxes for business owners. And I have our wonderful CPA. His name is Jeff Badu. He is the CEO and founder of Badu Tax Services. And so he is actually a CPA for several of our community members. So I wanted to be able to introduce him to you guys. And he decided to come on and educate you guys on taxes for business owners. And then we have a part two scheduled for you guys coming soon, so I'll be able to provide additional information on that as well. So without further ado, I want to go ahead and invite Jeff to the floor. Jeff, thank you so much for coming on and agreeing to do this masterclass for the community. I am so grateful, and you have the floor.
Yes, indeed. Thank you, Christina. Definitely appreciate you for having me tonight. Definitely appreciate everybody for joining. Welcome, everybody. And I do have, a bit of a presentation for you tonight. We will also open up the floor for some Q&A. And so please be on the lookout for that. If you have any questions or anything like that, please feel free to type your questions in the chat. And actually, before I go ahead and share my screen, Christina, am I able to share the YouTube link on my page, on my Facebook?
Yeah, absolutely.
Okay, absolutely. Let me make sure we get this going here. I always love to, spread the word, make sure everybody's getting the information, the content, and everything like that. I am a public speaker. I do speak to several groups, each year. I usually host over 100 workshops each and every year. And so what I'm doing right now is I'm just sharing this link real quick. I do have some folks on Facebook that love to tune in to some of the content. And so let me just go ahead and share that real quick. And here we go. Please bear with me. And here we go. All right. So let me go ahead and share my screen here real quick. And yes, if there's anybody that has any questions or anything like that, please feel free to chime in. All right. And so tonight I've been tasked to basically talk about tax tips for business owners. And of course, the question becomes, hey, what if I'm not a business owner? What if I am an aspiring business owner? Or what if I just basically I just don't own a business, period? Well, here's the thing in that number one, you should have some type of business, right? And I know the community here is filled with folks that have trust, interested in trust, have a trust set up, all that good stuff. And so tonight I'm going to really hone in on the business side of things, right? So if you don't have a business, my advice to you is have some type of business. Nowadays you can set up a business for pretty much anything. You can set up an Amazon third-party business. You can set up you can be a ride share. You can set up a tax business, right? You could pretty much set up a business for basically anything nowadays, and it's legitimate. It's good to go. All right. So my name is Jeff Badu, and I will be your presenter for tonight. So here's a quick agenda. I'll kick it off with an introduction of who I am, along with my purpose in life. And then we'll go over, now I won't bore you with the incorporation side of things, but I will mention it briefly. And then what we all came to listen to and talk about tonight, which is taxes, right? Around taxes, some things that we could do to save money on taxes. And then I'll show you a software that we usually utilize to track all of these things from an accounting and record keeping standpoint. And then we'll open up the floor for some Q&A. I'll also share some different information and everything like that, contact information, all that good stuff. If you do have any questions, please feel free to type them in the chat, and we will save some time at the end for some Q&A. So who am I? My name is Jeff Badu. I'm a licensed certified public accountant. I was born and raised in Ghana, came to the US when I was 8 years old. And I fast forward, I went to the University of Illinois Urbana-Champaign, where I received my bachelor's degree in accounting, as well as my master's degree in accounting. I went on to become a parallel entrepreneur and a wealth multiplier. And that made me the founder and CEO of Badu Enterprises LLC, which is a multinational conglomerate in the finance industry. And what we do is we provide a suite of financial services, including our primary company, which is Badu Tax Services. And that's the firm that provides tax preparation, tax planning, and tax representation for individuals and businesses across all 50 states in the US. And we also have clients that are physically based in over 25 countries at the moment. We also have other companies, including Badu Investments, which is our real estate investment company. While we're here tonight, I love teaching financial literacy. I'm very passionate about financial literacy. And we have the Badu Foundation that teaches financial literacy to the communities. And that's where we host the 100+ workshops throughout the year through. Lastly, my purpose in life is to inspire and support the super hungry to take hold of infinite resources in order to create an abundant lifestyle. For those who didn't get that, maybe you're in transition to another meeting, maybe you're getting ready for dinner, whatever the case may be. Let me just repeat it one more time. My purpose in life is to inspire and support the super hungry, including 100 of us plus so far tonight, that basically are very hungry, very dedicated individuals to take hold of infinite resources, such as what God has manifested in me to deliver to you all tonight in order to create an abundant, not a scarcity, but an abundant lifestyle. All right. And so let's go into the journey, into the presentation. Now, the only true way that I can tell you about what I'm going to talk to you about tonight is to really demonstrate. It's to show you a few things. And so what I'm actually going to do is let me exit out of this presentation here. And let me share an Excel spreadsheet, right, for my Excel fans out there. Let me just go ahead and share something with you. And this is basically what we're going to use as an example of a real life scenario, right? Something that is happening right now. This is something you could do right now. All right. So we're going to use a lady. Her name is Brianna. And Brianna basically came to a workshop like this. And when she came, to the workshop, or when she started working with our firm, she didn't really know much about taxes. She came to the workshop, heard some great information, and then she decided to work with us. So we have Brianna, who's a real estate agent. She's a real estate professional. And basically, she's doing pretty good for herself. She's 30 years old. All right. And she's ultimately doing pretty good for herself. She's a real estate agent. She's doing a lot of real estate throughout the year. But the challenge with Brianna when she came to us is that she didn't really have things set up in a way that's the most advantageous, right? It's not that she was doing anything illegal, wrong, or anything like that. She just didn't know what she didn't know until she came to us, and then she got to know. All right. And so Brianna has an income. Now, let me do something real quick here. We're going to do a few scenarios. We're going to do a scenario A, and then we're going to do a scenario B. All right. If I know how to spell, of course. So let's do scenario A. Brianna is a real estate agent making $150,000 a year in income. All right. She doesn't really know much about write-offs, things that you can claim as a business expense, your G-Wagons and all that, right? She doesn't know anything about that. So basically for Brianna, she doesn't know much about write-offs. So her expenses are virtually close to zero, right? And this is scenario A. This is without any tax planning, basically, without doing any sort of planning, proactive planning throughout the year. So that means that Brianna's net income or net profit, right, is going to be 150,000 minus zero, which is 150,000. Now, based on that, her tax rate is ultimately going to be roughly around 35%, right? 35%. Now, I know for a fact that nobody in this call today, I can only imagine that nobody in this call today wants to pay that. All right. And how I got to 35%, by the way, is between her federal income tax rate of 25%, her state income tax rate, or actually let's actually be even more, let's bump it down a bit. 20% federal income tax rate, 5% state income tax rate, and then there's a 10% self-employment tax, right? So she operates as a sole proprietor. She doesn't have any entities set up, no LLCs, corporations, trusts, nothing, right? She's just out there doing business in her name, her personal name. All right. And so her tax rate is 35%. So then what's going to be her tax liability? Let me make this simpler. Her tax liability is going to be the 150,000 times 35%. All right, that's 52,500. All right, and this is without any sort of tax planning, nothing like that. Now, it's not like she's losing all of her money to taxes or anything like that. However, I mean, this money she can very well use to go out and buy a piece of property. She can go out and buy a rental property with this money. All right. She can go out and give money to charities. If she has kids, she can fund her kids' college education with this money. But unfortunately, this is what she would have paid. Or let's just say before she even came to the firm, this is actually how much she was paying because she was doing no tax planning, no proactive tax planning throughout the year whatsoever. All right. And so now let's go through here. She came to the firm and said, hey, you know what? I want the full package. I want you to hook me up. All right. So now we have tax planning, what we call an S corporation. All right. And so since Brianna is doing active business, he runs an active business doing real estate. She basically needs to have an active business entity. All right. And so one of the first things that we did, and remember, we are going to have a part two where we'll get more advanced with this stuff. This is more the part one. It is not basic stuff. However, there is going to be a part two to this, right? So we want to keep it pretty simplified in this scenario. So she came to us and said, hey, I don't want to pay this, right? We showed her this number. She said she doesn't want to pay $52,500 in taxes. She said, what can I do? One of the first things we did was we set up an LLC for her, a limited liability company. What does this do? Number one, it protects her personal assets, meaning God forbid if somebody were to sue her and she loses the lawsuit, then they can, if she doesn't have the LLC, the limited liability company, then that means they can take everything that she owns, including her house, her car, everything, right? But now we set up an LLC, a limited liability company for her. So now she's protecting her personal assets. That's benefit number one. But benefit number two is we convert this LLC magically through a form called the 2553 S Corp election form. And please don't try any of this at home, by the way. It can be pretty dangerous. But we completed the 2553 S Corp election form for her so that we converted her company into an LLC that is taxed as an S corporation. All right. And so here's what that does. What basically that's going to do is, let me just copy this example for the sake of simplicity. It's going to knock down her tax percentage, her bill, down from 35% to 25%. Why? Because now she no longer has to pay self-employment taxes. All right. No more self-employment / FICA taxes. Why? Because as an active business owner that does not have an S corp, you have to pay self-employment FICA taxes on your profits, your income. All right. But by having an S corp structure, all of a sudden she no longer has to pay self-employment / FICA taxes. All right. But she said, okay, that's good. What we saved her, look at this. If we take 52.5 minus the 37.5, we just saved her $15,000. This is money she can use to go out and buy a piece of property. This is money that she can use to fund, if she has kids, her kids' college education. This is money she can use to pay for a wedding if she's about to get married. And of course, weddings are way more than this amount. But nonetheless, We just saved her $15,000 through one tax strategy, and that is by setting up a legal entity for her, right, to not only protect her personal assets, but also to allow her to convert that entity into an S corporation. LLC taxes an S corporation. Why should somebody set up an an S corporation, or LLC taxes an S corporation? It is to save on the FICA taxes. This is applicable to those that have an active business, right? Your main hustle, basically. You're a tax accountant, you're a real estate agent, real estate attorney, whatever the case may be. This is one way that we can save you money on taxes, all right? But she still doesn't want to pay $37,500. And so that's when we introduce her to scenario C, and that is basically the S with the S corp and, right, get this, and tax write-offs, tax deductions. All right. So this is where it can get a little sweet, in that Brianna didn't know that she can claim business expenses in her business. She didn't know that by being a business owner, she can leverage some of the things that some people may view as personal expenses into business tax deductions, right? Business tax deductions. All right. Now, here's what I mean by that. As a business owner, for example, you have to pay for certain things. You have to pay for a laptop for your business, right? Because that laptop that you're using to go out and, you're pretty much writing up contracts with clients. You're posting pictures online to set up showings in her case. And so that all of a sudden becomes a business tax deduction. All right. Not only that, but the cell phone that she's using to conduct business with clients, the device itself and the phone bill is also tax deductible. The AirPods that I'm using right now to conduct this meeting today, that is also tax deductible. All right. The water that I'm drinking to stay hydrated, and if the IRS were to audit me, by the way, for it, I have proof of this video that I'm utilizing it in a business capacity. All right. And then when you go out to eat with your spouse, with your loved ones, with your business colleagues, future clients, parents, whatever the case may be, you start talking business with them and you pay for the meal. Guess what? That becomes 100% business tax deductible. That trip you're about to take to the Bahamas, and you bring your kids along with you, you bring your spouse, you bring whoever it is with you, and you sponsor that trip, and you guys start talking business, you declare what we call a board meeting. All of a sudden, that becomes business tax deductible. The suit jacket that I'm wearing to host this meeting today, guess what? Since I'm in a business capacity and I got to look presentable to you tonight, that becomes a business tax deduction. The car that you're driving to get to and from places, whether it's a Tesla, a Cybertruck, a G-Wagon, a Maybach, whatever car it may be, guess what? Now that becomes a business tax deduction. All right. So talking through Brianna going through all of her expenses and everything like that, we're able to now find $50,000 worth of deductions. $50,000. So here's the new scenario. All right. So now this is scenario C, and that's with the S corp and the tax write-offs. All right. So we're able to find $50,000 for her, and look at this. Now her tax liability goes from $37,500 to $25,000. That's two tax strategies now. All right. Remember, she started with $52,500 that she had to pay, and now we're dropping down to $25,000. But as a wise man or woman would ask, well, how do I knock this down even more? This is good, but how do I knock this down even more? And I'm glad you asked. Now we enter scenario D, and this is where it gets really, really intense. All right. So scenario D is with S corp, tax write-offs. Please bear with me here. And we introduce real estate investments. Real estate investments. Get this, Brianna is a real estate agent. She's out there selling real estate on behalf of her clients. All right. And so what better thing to invest in than the thing that she's very well selling to her clients? And so she asked, okay, well, what can I do to knock down this $25,000 tax liability down to zero? Right? What can I do to knock down this $25,000 tax liability down to zero? And I'm glad she asked. What we can do is she can go out and buy a piece of real estate, a rental property. And since she is qualified as a real estate professional, she'll be able to claim a tax deduction of up to, if she bought it in 2020, let's say 2024, a tax deduction, we can go up to 20% of the purchase price of the piece of property. 20%. All right. And so that means that she needs to find a piece of property that is worth at least five. Let's do the math real quick. She needs to find a piece of property that is worth at least $500,000. All right. And so here's what Brianna did. She goes out and by the way, she's in Illinois. She's based in Chicago. That is my quote unquote hometown. I was born in Ghana, but I was raised in Chicago. Shout out to Chicago. And so basically she goes out in the neighborhood of Woodlawn in Chicago, which is on the south side. And she finds a beautiful piece of property, which is a 4-unit rental property, investment property. And she goes out and buys a 4-unit investment property. All right. And so let's go through the scenario here. 4-unit investment property. Purchase price, $500,000. All right. And then here's how much she would put down. Here's her down payment. And so what she utilizes is the FHA loan, the Federal Housing Administration loan, that allows her to buy up to 4 units with as little as 3.5% down payment, right? And so that's 17,500. Get this, the taxes that we saved her, she can use that money as a down payment on a piece of property that's going to generate her income for the rest of her life, basically, right? So her down payment is 17,500. And here's how much rental income she can make. We use what we call the 1% rule. We take the purchase price, multiply it by 1%. And let me make sure this is right. And let me see here. And so basically, yep. So let's do the 1% rule. And so we do the purchase price times 1%. And so that's going to give her $5,000 a month in rent. All right. And here's what we do. So that's going to be her monthly rental income. And then her monthly rental expenses, let's just do modestly, let's just say it's $3,000 a month, right? That includes the mortgage as well. All right. And then that means that her net cash flow, the amount of money that she's going to make each month, her monthly cash flow, which is $5,000 minus the $2,000, that's going to give her, or 3,000, sorry, that's going to give her $2,000 a month in cash flow. What's going to be her annual cash flow? That is going to be $2,000 times 12. That's $24,000 in income profit that she's going to make on her piece of property, on her piece of real estate. All right. And so one may ask, okay, well, here's the thing. She's basically using 17.5 and going to make $24,000 with it, right? I mean, who wouldn't want to invest in this type of investment right here, in this type of opportunity? But here it gets even better. Remember, we're going to introduce scenario D, and that is with the tax write-offs and with the real estate. Here's what's going to happen. She's now able to claim a tax deduction known as depreciation. All right. Depreciation tax deduction, where she can do what we call a cost segregation study on the property. And what she can do with this depreciation is it's going to be the $500,000 times 20%. She can claim a tax deduction of up to 20% of the purchase price of the property in the first year of owning the property. That is one of the benefits of owning real estate. This is known as accelerated depreciation or cost segregation. And so here's what she can do. She can now take the $100,000 profit in her business, in her S Corp, minus the $100,000 depreciation tax deduction, to all of a sudden, let me insert something here real quick. All of a sudden, if we do this, and so the depreciation deduction is going to be 100,000. And so now her net profit, her net taxable profit is going to be zero. All right. Because she can use the depreciation, right? She can use the depreciation to all of a sudden offset her profit in her S Corp business. All right. And so let me do this here. So we got this. There we go. And so now all of a sudden her net taxable profit is zero. And now her tax rate all of a sudden becomes zero. And so through proactive and effective tax planning, what Brianna can do is she can, number one, convert her business into an S Corp. Right? She didn't have an S Corp or anything like that. She can claim tax write-offs, some tax deductions in her business that ultimately allow her to claim, some deductions in her business of $50,000 in her case, very conservative. We can usually find more than that. And that way her net taxable profit or her net profit in the business is only $100,000. And then to save the rest of the money, to save the remaining $25,000 in taxes, we go out and we find an investment, real estate in this case, where all of a sudden we take the 20% of the purchase price of the property she purchased, which by the way is still making her, right, $24,000 a year in cash flow, right? Money in her pocket every month. And now her tax bill for that year, 2024, zero, right? She pays no money in income taxes by leveraging three strategies: the S Corp, the tax write-offs, and a real estate investment. And that's just one property, by the way. Imagine Brianna does this every single year. She makes $150,000. She spends, quote unquote, $50,000 through write-offs. She invests 17. I mean, she can't do the FHA loan every single year. She does have to increase her down payment, at some point. And so as she's building up her wealth, as she's building up her money, her income, she's all of a sudden going to keep buying properties. Every time she buys a property, she can do the cost segregation study and claim a depreciation tax deduction of 20% of the purchase price of the property she is acquiring. By the way, since we have a new president, that rate will most likely be increased to 25%. Let me repeat that one more time. For real estate, for my real estate investors out there, aspiring real estate investors, that deduction percentage I mentioned, I said it was 20% earlier. It will most likely go up to 25% effective 2025 when the tax law reform comes out under the new president that we have coming up here in the United States of America. All right. And so instead of writing off, 20%, Brianna is going to be able to write off 25% effective 2025 tax year. Right now it's at 15% for 2025, but it will most likely get bumped up to 25%. So for example, if you buy $1 million piece of property, piece of real estate, you'll be able to claim a tax deduction of $250,000 just for buying real estate, a rental property. A property that's making you money every month, by the way, assuming you're managing it correctly, you have the right teams in place, and ultimately you're structuring the deal correctly. All right. And so this is all good, right? But how do we track this stuff, right? How do we go ahead and keep track of this? My advice to you is use a system like QuickBooks. QuickBooks basically, this is QuickBooks Online, by the way. It allows you to track your business income and expenses efficiently, effectively. One thing about the IRS is they value paper trail a lot. They value things that are date stamped, transaction number stamped, time stamped. What QuickBooks can do is you will link all your business accounts, your checking account, savings account, and everything like that. Each business should have its own QuickBooks account. And basically what that does is it'll auto-populate all the transactions effective January 1st, 2024, by the way. You can go all the way back to the beginning of last year. It'll auto-populate all your transactions for you. And all you do is go in there and say, okay, this is meals, this is travel, this is home office, this is utilities, right? You're pretty much categorizing the expenses. And then it pulls together a profit and loss report for you, a P&L statement for you, so that you can go ahead and, file your taxes and ultimately track your business performance throughout the year. All right. And so I know that was a lot. I can imagine we have a lot of questions. I do see a lot of activity in the chat. Let me go ahead and share my contact information real quick before we get into the Q&A. So here's my contact information, right? Information is only as good as what you do with it. And so please, proceed accordingly. Information is only as good as what you do with it. What we shared tonight is real, it's legitimate. It's something that, we have some clients that are taking advantage of. We have some clients that do this through proactive tax planning. And so here's my contact information here. If you scan this QR code, especially now that we're in tax season, happy tax season, by the way. If you scan this QR code, it will take you to a link to a quick 1-minute questionnaire, in case you're interested in doing business with us, in case you're interested in leveraging the strategies we went over today. Please let us know that Christina and the team sent you so that we can, we can send a thank you to her and the team as well. My email address is jb@badu, B-A-D-U, taxservices.com. Once again, jb@badu, taxservices.com. Phone number 773-819-5675. Once again, 773-819-5675. I'll go ahead and share the link in the chat as well in case you're on your phone, your mobile device. I'll go ahead and drop the link in the chat for you. But you can feel free to scan this QR code. I'll post it again here shortly. Please feel free, right? Scan the code and ultimately fill out that quick, very, very quick 1-minute questionnaire. One thing that you notice about me, I love to save a lot of time for Q&A because I tend to speak a lot of, information. And so I love to save a lot of time for Q&A. So we got 22 minutes today for Q&A. Let me go ahead and drop the link in the chat, and then let's also go ahead and, let's go into some questions. Anybody with any questions, any comments they want to share at this time, please? Right? Any questions? All right, so we got M. Sherelle. M. Sherelle, please go ahead and unmute yourself.
Yeah, how you doing, buddy?
Yes, indeed, doing good.
Yeah, can you explain the Augusta rule?
Yes, indeed, absolutely. I'm glad you asked, and man, it's tonight we could spend literally hours and hours talking about tax strategies and everything like that. I wish we had more time for it. But we do have a tax strategy within our firm that's very famous. It is called the Augusta Rule, like Augusta, Georgia. And the Augusta Rule basically allows you to rent your home from yourself to your business for up to 14 days a year and charge the business up to $1,000 per day for a $14,000 rent tax deduction. What happens there is your business gets to write it off as a business expense under rent expense, but you as a homeowner don't have to pay any income taxes on it thanks to the Augusta Rule, which allows you to rent your home from yourself to your business or anybody for that matter for up to 14 days a year, charge any amount that you want. In this case, it's $14,000 to your business. And then you get to write it off and basically claim tax-free income as well. All right. Does that answer your question, Shura?
Yeah, appreciate it, buddy.
Absolutely, no problem. Now, before we get to the next question, let me hop in the chat real quick. Now, we got a lot of activity here. Let's see here. Let's see. Got in. Okay, here we go. And question from Meredith Rose. She says, I took on EIN for the FBO to the bank to pen a checking account, and he said I had the wrong EIN number. It's for a business because it says employer EIN. How can I correct the number? And so I'm sure Christina and the team can. Christina, do you want to chime in on that, or is that something we take offline?
Yeah, that's going to be offline. We're not answering any trust questions during this masterclass.
Yes, indeed. Thank you for that, Christina. Appreciate that. All right. Here we go. Let's see. We got another comment. Yes, because I did business the old-fashioned way of sole proprietor LLC. Now I want to do my business only through trust. So all businesses I have is halted until I get Business trust and order. Okay, sounds good. Let's see. Will we have access to this video like our class resources? Christina, any answer to that?
I'm gonna put the replay link in the Facebook community and the Telegram chat.
Yes, indeed. Thank you for that, Christina. Appreciate that. All right, all right. Please keep your hand raised. We will get to your questions here. I love to save a lot of time for Q&A, but I do want to get to these questions that were asked first. This one is a private question. Hey, Jeff, I am a master barber and I pay quarterly taxes for cutting hair, but I don't have an official business with a separate EIN. Should I set up a business entity? Which one should I do? Yes, you should. For the sake of this class, LLC for now, right? LLC, and then I'm sure Christina and the team will give you the nice, hookup in terms of putting that into a trust, right? Refining that into a trust. This can very well, everything I've said tonight works very well in a trust, by the way. And so, yes, you should have a business entity for now. I would say an LLC, a standard LLC is okay. And then as you advance in the business, we can definitely give you the hookup for sure. All right. And so here we go. Joe says, I hope I can receive this video because it is in my country in the middle of the night right now. Totally understand that. Thanks for that, Joe. I appreciate you staying up and watching this. Nick says, we'll be able to get a copy of this. Yes, you will. Angela says, what about content creation on a trip? 1000%. That's one of my favorite groups of travel folks are content creators. I mean, it's so easy to prove that you're traveling for business, right? Because nowadays, you can literally go on a trip to Jamaica and write an article, write a content. And you can tell the IRS if they audit you that, hey, I was on a trip to Jamaica, I was writing a content, an article for a client, they paid me, but I just happened to be in a different country, right? Nowadays, business is global. The world is global. The world is not just domestic. Business is not just done in your city anymore. Business is not just done in your state. Business is not just done in the US anymore. Business is not even just done across the world anymore. Business is done in space now too, right? There's people going out in space and doing some things that we don't know what they're doing there. But nowadays, we really have to think of ourselves as Apple. We got to think of ourselves as Microsoft, we may not be there now, just yet, but we're a multi-trillion-dollar enterprise or an aspiring multi-trillion-dollar enterprise that will get there someday. So we have to have the mindset of what they do, what these folks do, right? And so nowadays, wherever you travel to, that is a business trip. That's a business trip, right? We don't take vacations anymore. We take business trips, all right? That's one of my models in life. Question here. So your tax strategist and love it. Yes, indeed. Thank you for that, Christina Buckley. And then we got a comment, will this be available? And it's like the most common question. Yes, it is available. And thank you, Christina, for dropping the link to the forum, right? To anybody that wants to work with us. Christina Buckley says, with the Augusta rule, what would you need to prove that you've rented your property in a business sense? A lease, that's it. A standard lease. It could be a one-page lease agreement, that's fine. And then have meeting notes, have meeting minutes, proof that you had those meetings, right? You had the business discussion, whether it was a client meeting, you met with your spouse and you talked business. That is always good to do. My wife and I would meet at least on a weekly basis to talk business. And guess what? That would be a perfect example of the Augusta rule. All right. Earl says, what type of structure do you have as far as foreign entities, trusts, and private foundations? Let me see here. I would say that's going to be more of a part two, right? Let's save that for the part two. But for now, remember, LLC, right? Let's keep it simple. LLC for now. And somebody's asking for the Telegram link. Can a business invest in a film company and get a tax write-off? I know it's possible for an individual. Yes, you can. Yes, you can. The answer to most tax questions regarding write-offs, can you do it? The answer usually is yes, you can. We just got to figure out how. Right? Rich Dad Poor Dad taught us that if you haven't read the book, I strongly encourage you to check it out. But Rich Dad Poor Dad taught us that it's not about if you can afford it. Don't say the words, I can't afford it. It's about how can I afford it? It's the same concept with the tax code. It's not a matter of if you can deduct it or not. The answer to the question is usually yes, you can. The real question is how can I write it off and make it legitimate to the point where if I were audited, I would have no issues. All right. Angela says, I have a trip at the end of the month. Perfect. You came to to this just in time, just in time. Do you assist with C Corp's tax planning? Yes, we do. It's not common, but yes, we do. Angela says, never thought about a meeting with my husband. There you go. There you go. And then Manaya says, how much should a business make to switch over LLC to S Corp? Magic answer, $40,000 or more in net business profit. $40,000 or more in net business profit, income minus expenses. What is the maximum? Thomas says, what is the maximum vehicle deduction percentage or amount? And does the vehicle need to be under a business entity? Maximum deduction for 2024, it is 21,400. If the car is not an SUV or truck, it is $21,400. If the car is not an SUV or truck, and you spread out the remaining amount over a 5-year period, by the way, known as depreciation. If it is an SUV or truck, like a Cybertruck, then it is 60% for 2024. It is 60% of the purchase price. So if you bought the car for $100,000, you get to claim a tax deduction for the car of $60,000 if you purchased it in 2024, or you placed it in service in the 2024 tax year. All right. Are there tax advantages to a multi-member LLC versus single member? None at all whatsoever. Zero tax differences or advantages. It's just the type of tax return that you file. Nasir says, does the tax liability subtract from the net profit? It does not. It is calculated after the net profit. It's a percentage times the net profit. Antonio says, why an S Corp, not a C Corp? It's because of the double taxation. You cannot pull profits out of a C Corp easily. And basically it's the double taxation component. And quite frankly, C Corps are a bit more complicated to manage than S Corps. So simplicity and the avoidance of double taxation is why I like S Corps over C Corps. The benefit of having a quality tax team / strategist is that they uncover the opportunities for you to save money and create real generational wealth. Thanks to Abena. Shout out to Abena on the Badu Tax Services team. Also, shout out to Nasir. Also, we got Giselle from the team joining us as well. All right, so that was a lot of stuff in the chat. Let's go back to the question. Stacy Petty, please go ahead with your question.
Hey, Jeff, thanks so much. Appreciating all this great information. Question for you. Actually, somebody kind of asked my question, but I had another part to it. It's about the car write-offs.
Okay.
So we bought our car towards the end of 2022. It's an SUV, but it's not like a big one. It's like a Atlas, a Volkswagen Atlas. So would we still be able to take any kind of deduction from that?
Yeah, that's a great question. And so one of the biggest misconceptions out there is that the car has to be 6,000 pounds plus for you to get any type of write-offs. It is a complete myth. The car could be, 1,000 pounds, right? And you can still get a tax write-off. It just depends how much of the car you can deduct. So in your case, the Volkswagen Atlas, since this is an SUV, we're very comfortable. Let's say you bought it in 2024, you can claim a tax deduction of 60% of the purchase price, right? So if you bought it for $100,000, you can get a $60,000 tax deduction. If it was not an SUV or a truck, then it would be $21,400 as your deduction in year one, right? 2024. And so if it's an SUV or truck, it's 60% of the purchase price. If you're talking about 2024 tax return, if it is not an SUV or truck, then it is $21,400 is your deduction for the 2024 tax year. All right. Does that answer your question, Stacy?
Kinda. I just want to make sure. So if we got it at the end of 2022, are we still able to claim any kind of deduction?
Yeah, definitely. I mean, which year are we applying it for the tax plan? Are we doing 2022, 2023, 2024? By the way, in our firm, one unique thing is we will look at your tax returns from the past 3 years. One more time, we will look at your tax returns from the past 3 years. We'll go through 2022, 2023, 2024, see if you're missing anything. So the question becomes, okay, what year are we talking? If we're talking 2022 and we're going back to amend it, and apply some beautiful deductions for you, Stacy, then it's 100% bonus depreciation tax deduction. Whatever you bought it for, we can claim 100% of the purchase price if we're talking 2022. If we're talking 2023, then it is 80%. If we're talking 2024, then it's 60%. It just depends where you want to pick your, you want to pick
Yeah.
your gift, your benefit.
All right,
Exactly.
Jeff, we'll be scheduling our call. Thank
Amen to
you.
that. Yes, indeed.
All
Looking
right.
forward to it, Stacy. Absolutely. All right, all right. Let's go ahead, Mariah, please. Or Maria, sorry. All right, we got a hand raised by Maria. You can go ahead, please unmute yourself. All right, Maria going
Hi.
once. Go ahead, please.
Oh, okay. So I think I'm not sure if it's a FSA or a HSA that you can pay your spouse income through a medical deduction, or pay
Yeah,
anybody in your family through a medical deduction.
that's an excellent question. So I would lean on the side of HSA, the health savings account. And basically, this is an account that for 2024, you're allowed to put for a family $8,300 into the account. You get a tax write-off, so you get to claim it as a personal tax deduction upfront right away, or at least when you file your taxes. And then the money grows; it gets invested into the stock market. Let's say the S&P 500 index, which is composed of the top 500 companies in the U.S. So it gets to grow and grow and grow, and then when it comes time to take the money out, preferably in retirement for medical expenses, you don't have to pay any income taxes on that money.
Okay, that's not what
However,
I'm talking about.
okay, which
There's some
go
I'm
ahead.
not it's one of those three-letter acronym that you can actually pay your spouse or your family member through like you can the same amount, like say if it's like 40,000 that you want to write off, that will be income tax free.
Yeah, so basically, are you talking about them like using the money for medical expenses?
Yes.
Yeah, so
And it's
it's
basically like
actually
a reimbursement, but it'll be
exactly. That is
equivalent.
actually the HSA. That's actually the part two of what I was going to mention, in that
Okay.
one way you can take money out of the HSA tax free is to physically pay for a medical expense. Like they'll give you a debit card to pay for it. However, the second way is to request, let's say you've incurred $10,000 in medical expenses over the past 3 years. You can go to the HSA company and say, hey, I've spent $10,000 in medical, or my spouse has spent $10,000 in medical expenses. I want to request a reimbursement check. I would recommend, by the way, you delay this as much as possible. But let's say you need the money right now. You want to buy a piece of property.
So
You can request. Exactly.
we're 1099s.
I'm sorry, what was that?
I said for me and my family, we're 1099 workers. We're medical couriers. So
Absolutely.
we're not getting it from a separate business, but we do have like Aflac, and we do have other things that we have used. But this year, I'm sorry, I forgot the number of the form.
For sure.
But I think it may be I think it may be it's either HSA or the HRA.
Got it. Okay. Yeah,
But
HRA can do something similar too, right? They all can do the same things. It's just which one is more beneficial. My advice, HSA. I love that account. It's a big, big benefit account for sure.
okay,
For
because how
sure.
will we ask ourselves to pay out something we're already paying out?
Yeah, I mean, it's basically through the HSA company, essentially, right? And so so basically the HSA company acts as a trustee to the HSA trust, right? And then they cut you a check for whatever amount you request from them. So as long as you fund your HSA account that's been growing, you can request a reimbursement at any time to cover or reimburse you for any medical expenses.
So I think it is a HRA.
Absolutely.
Because
That can do the
we
same
don't
thing
put
too.
anything in, it comes directly out of the account.
For
So we
sure.
pay up
Yeah,
front
that's
for it. And they said
exactly.
that we can actually take that those medical expenses, and we can use it as a source of untaxable income.
Correct.
Does that make sense?
Yeah, it makes sense. It's set up through a C corporation. That's how we usually structure those.
Okay, but we're a LLC, because if we do it through a C corp, we're not gonna be able to take family I want to say discounts, but
Right.
we're not able to use our children as employees and so on and so forth.
Yeah, I would say, Maria, I would say let's definitely talk after the call. There is a way. We have clients that do this. There is a way we can structure this to make it advantageous for you.
Okay.
Mhm. Yes, indeed. Sounds good. And I
All
just
right. Thank you.
reshared yeah, no problem. No problem at all. I just reshared the slide. So we got 3 more minutes to go here, man. Great question so far. Let's go to Alan. Alan, please ask your question.
Yes, first of all, thank you very much for being here. And boy, where you have been when I was 20. And then can we do all this thing only with the S corporation without LLC?
Can you repeat the question one last time, please? I want to make sure I understood it.
Can we do all this thing you mentioned without LLC, with the S corporation, with the S corp?
Great question. Great question. So an S corp is not a legal entity. An S corp is not a legal entity. It is simply a tax election. So either a C corporation can elect to be taxed as an S corp, or an LLC can elect to be taxed as an S corp. So you can do this to a corporation as well, right? And or you can do this through an LLC. So it has to be one or the other to leverage these deductions. But guess what? We can do all of this through a C corp too. It's just a bit more complicated, a bit more steps. So Alan, to answer your question, yes, we can do this through pretty much any entity.
No, I don't want to C corp at all. You answered it already, but yeah, no C, just
Right, no
just
C.
this. No
Yeah,
C, no
yeah.
LL, but okay, no problem. And you don't have a
Absolutely.
location in Florida, South Florida?
Yes, we actually have a team member who's based in Florida, one of our best lead preparers. So yes, we do have.
How far are you in the South?
So basically it's close to the Miami. It's pretty much Miami area.
Okay.
One thing to keep in mind, we're a virtual CPA firm, so we do work with clients to virtually.
No problem.
Okay. Yes,
No problem.
indeed.
Thank you again.
Thank you for that, Anna. Absolutely, no problem. All right, all right. We got time for one last question. Let's go to Latoya, please. Go ahead, Latoya. Last question.
Hi, I actually don't have a question. I just wanted to say hello because I am a prior client of yours from some years ago.
Absolutely.
Nice
Bad
to
or
see
bad.
you. I
Yes,
just
indeed.
did. So good to see you doing wonderful, wonderful, wonderful things. I think I was with you from the very, very, very beginning.
Mm-hmm.
And now I'm a part of this community. So just well done and hello.
Amen to that. Thank you for that, Latoya. Appreciate you for joining. Hope all is well. And yes, Latoya was one of our very, very first clients in the firm when we started back in 2016, actually. So definitely, appreciate you for joining us tonight, Latoya, and great job investing in the community. All right. And so I definitely want to be respectful of everybody's time. We will have a part 2 to this. I did drop the link in the chat to anybody who wants to work with us, talk to us, right? No obligation consultation. It's just a 1-minute questionnaire. I did share the QR code, and I also dropped the link in the chat as well. With that being said, I'll give it back to Christina. We're at 7 p.m. Central on the dot, 8 p.m. Eastern, and I'll give it back to you, Christina.
Thank you so much. Thank you, Jeff. I appreciate you coming on and educating the community. So I'm at a point where I have to upgrade my Zoom because we have reached capacity at 100 and there were 50 people on live stream. So that's 150, but there was an additional 20 people that wanted to join that were not able to. So now I have to upgrade my Zoom so that we can have more than 100 people. So I do apologize for those of you who were not able to get into the Zoom earlier as you wanted to. A couple of you guys messaged me. So with that being said, thank you, Jeff, for coming in, pouring into the community and educating us on these tax strategies. And Jeff has agreed to do a part 2 for us. He's definitely going to dive into more details when it comes to you guys filing taxes for your trust. So the part 2 is going to be on January 28th at the same time. So it's going to be 7 p.m. Eastern Standard Time. So we will be my team and I will be putting that information in the Facebook community and in the Telegram chat for you guys. So without further ado, we are going to end our masterclass. So everyone have a blessed and amazing day. And if you guys are interested in working with Jeff and his team, I put the link inside of the chat and the replay. So you should have received an email. The email also has the link. Please, when you are filling out the link on the section that says referral, put 7 ways to wealth, okay? And the replay is going to be available. So the team is going to send you guys a text message with the replay link so that you guys can watch it from the beginning if you missed it. So without further ado, everyone have a good and amazing evening, and we will see Jeff back on the 28th. So if you have any other further questions dealing with taxes and the trust specifically, then save those questions because Jeff is coming back on board. So everyone have a good night, and we'll see you soon. Bye-bye. Thank you, Jeff.
Absolutely. Thank you, Christina. Thank you all. Have a great night.
Thank you, Christina and
Thank
Jeff.
you.
Thank
Yes,
you.
indeed.
Bye, everyone. Thank you.
Thank you all.
Absolutely.
Thank
Take
you.
care.
Good night.
Christina, you're the greatest.